As I mentioned, 10 years have now passed since the depths of the financial crisis, a painful part of our history that cost many Americans their jobs, their homes, and for some, their hopes and dreams. In addition to holding interest rates low to support the recovery, we have also taken many steps to make the financial system safer. In particular, we're holding the largest banks to much higher standards in the amount of capital and liquidity they hold and in the ways they assess and manage the risks they take. I'm confident that the system today is stronger and in a far better position to support the financial needs of households and businesses through good times and bad. We continue to work to sustain these fundamental improvements while also ensuring that regulation is both effective and efficient. Now let me go into more detail about the developments that motivated today's policy decision. Both household spending and business investment are expanding briskly, and the overall growth outlook remains favorable, and several factors support this assessment. Fiscal policy is boosting the economy. Ongoing job gains are raising incomes and confidence, and overall financial conditions remain accommodative. These conditions are consistent with our summary of economic projections for this meeting. The median of committee participants' projections for the growth of real GDP is 3.1% this year and 2.5% next year. Job gains averaged 185,000 per month over the last 3 months, well above the pace needed in the longer run to provide jobs for new entrants to the labor force. The unemployment rate stood at 3.9% in August and has been near that level since April. Smoothing through month-to-month variations, the labor force participation rate remains about where it was in late 2013, a positive sign given that the aging of our population is putting downward pressure on participation. We expect the job market to remain strong, and the median of committee participants' projections for the unemployment rate later this year is 3.7% and a bit lower than that in 2019. Overall consumer prices, as measured by the Price Index for Personal Consumption Expenditures, PCE inflation, increased 2.3% over the 12 months ending in July. The Core Price Index, which excludes the prices of energy and food and tends to be a better indicator of future inflation, rose 2% over the same period. The FOMC seeks and expects to see inflation remaining near our 2% longer run objective on a sustained basis. At any given time, inflation may be somewhat above or below 2%. For example, the recent rise in oil prices has pushed inflation a little above 2%, but we expect this to be transitory as is reflected in our projections. The median projections for both the overall and core inflation measures remain very close to 2% across the whole projection horizon.